Okay, so I make that 3:30 exactly. I'd just like to welcome everybody to the first in a series of webinars. BHP and ITF, delighted to have 4 esteemed speakers here today. Hopefully keep it lively for everybody. I'm going to stand in the shoes of Mr. William Beckett and have a go at chairing this today. I'm sure that hopefully I'm never going to live up to that because I don't chat as much as him. So I will crack on accordingly. We've got just a little few housekeeping things before we crack on. Hopefully everybody's quite up to speed and au fait now with using Zoom. Please ask questions as we go. You will see at the bottom of your screen, or it may be at the top of your screen, a little Q&A box. If you want to raise a question in there anonymously, you can do that, or just raise them as we go. I'll pick those up as and when, or we might have a Q&A section at the end. Let's see how we go. There's also a chat function. So if you go into your participants box, you're able to also communicate either with all panelists or any attendees. So again, please feel free to make comments. We want to make it as interactive as we can. If I just run, hopefully everybody can see my screen. So in terms of our agenda, the agenda, to be honest, has changed on an hourly basis, because as soon as we decide on what our content would be, things keep changing. So right up to the weekend, we were doing something slightly different to this. We were hoping that we'd been a little bit further down the track in terms of decisions on Brexit. Unfortunately not, but we have got a slot in here. It's not too late, so Andy's going to do us a slot around that. So first of all, I'll just trot through and do a little bit of background around a survey that we did in conjunction with our Creston network earlier on in the year. I'm sure most of you are all here to actually listen to Paul. So Paul's going to give us a high-level view from the Bank of England. We'll then move on to Peter. Peter will give us an overview about how the International Trade Forum can continue to help and support international trade and growth in this COVID period. Very mindful that actually traveling to trade shows is very difficult at the minute, but there is still innovative ways in terms of getting around that. So Peter will trot through that. Andy, I've pulled in at last minute. Planning for Brexit it's not too late. So yeah, Andy's come off the bench. Thank you for that. And then Chris always gets the graveyard slot, but he's usually he usually pulls it out of the bag. Chris was originally going to talk through what we were expecting to see in the autumn statement. Unfortunately, that got canned. Well, it might be fortunately, that got canned at the back end of last week to be replaced by the winter economic plan. So we thought it'd be helpful for everybody if Chris just did an overview of some of those announcements that came out. So Q&A at the end, but again, as I said, please feel free to raise questions as we go. Let's make it interactive. Sorry, there's a bit of a delay when I press my button to move it forwards. Oh. So, just by way of background, BHP are part of an international network called Creston, and way back in December 2019, seems absolutely ages ago, we commissioned a report across the firms in the UK to actually look at international trade. And I think hopefully some of the people on this call were actually responded to some of that, to some of those questions. Timing couldn't have been any more poor. I remember it well. Glossy copies were delivered to BHP's back door on the morning after Boris basically told us all to stay at home. And we have a picture of me and John Warner with a massive pile of reports, glossy reports coming in. So first of all, waste of money. And then secondly, it was out of date. So we thought, right, well, what are we going to do now? So we actually commissioned a report in May 2020. So, you know, just slightly after being in the thick of it. And we wanted to gain views of businesses, SMEs, of how their mindset had changed in terms of international trade as a growth strategy. The original purpose of why we commissioned the report was actually so that we were able to try and feed back to government on areas in which support was required. We've also been involved with, it's called the Association of Practicing Accountants. Again, hopefully you'll have received some of the surveys that we've sent out, and it's specifically so that we can lobby government and are able to feed back as to what actually is happening on the ground. So it's a great route for us to go into bays and senior ministers, and it really is to understand and listen to what's actually going on out there, and particularly at a local level. So that was the reason why we commissioned the report. I've pulled out a few highlights or lowlights potentially, and this is really what's driven the content and the speakers that we've got today. So interestingly, 71% of the businesses that we surveyed indicated that pre-COVID they were already exporting or trading internationally, which is great. But actually, when you looked at it, 55% of the businesses actually had delayed or cancelled plans to export. We're going to actually test the water shortly, so we've built in some polls on here, so hopefully everybody is au fait with their fingers on the button. We'll be launching some surveys on this to keep it interactive, but also so that we can drive any future content, because we want to put webinars on that people are interested in and wanting to come and talk to us and listen to. This is probably one that I've pulled this out for Paul's benefit. So 45, and this was in May, and I think we change our minds every week. 45% of business leaders expected international trade to return within 12 months, and that was the old V-shaped recovery. Are we a V? Are we a W? Are we a long V with lots of W's? Be interested to see Paul's view on that. And a further 19% were expecting it to return within months. And I think, you know, on the ground, myself, Chris and Andy talk to businesses on a daily basis. And actually, there's a huge amount of positives out there. And then I pulled this one out with a bit of, so again, you know, to pick up around the whole Brexit, 79% of respondents believe that the efforts of our politicians and government have damaged the reputation of the UK on the world stage. So, you know, we desperately need that trade deal to happen, and Andy will pick up some of those points. Biggest challenges to trading internationally. Again, I've pulled out the top 5. A couple of them we'll pick up on today, but just out of interest, tax, VAT and duties right at the very top. So Chris and Andy will pick up on some of those points. Trade barriers, the other ones that were in here were knowledge. Again, Peter will also probably pick up on some of those in his section. And then actions to overcome barriers, top 1, no surprise there, free trade deals. So it'd be interesting to see where we get to in the next 2 weeks on this, and Andy picks up some of the timelines on his section. And then international markets, so which international markets do you expect to grow for? No surprise here, Europe, the top 1, 58%. Again, all comes back to the importance of the next 3 months that we've got. So that was a very brief whistle-stop opener from my perspective to set the scene, really. So before we move on to Paul, we're just going to ask you a couple of questions. Again, the questions that we're asking today will help drive content for the future. So Lucy, if you could launch the first one. So the first one, how likely is your company to consider expanding its international trade in the next 3 years? Just interested to see how this pans out versus this survey that we carried out in May. So that's very encouraging. I'm assuming the not applicables will be for my fellow professionals and intermediaries on the call. How likely is your company to consider expanding? 41% very likely, 14% quite likely, so majority 55%, which is good. Next one, Lucy. So second question, has your business delayed or cancelled any plans to export to a new trade or new market or trade overseas due to COVID? Again, also very encouraging, so all positive. So Peter, you'll be glad to know it sounds like the series we can continue with people. So thank you for that. Next up, we have Paul. So Paul is, let me just find my slide. Paul Mount is the Deputy Agent for, let me just stop sharing my screen. Deputy Agent for the Bank of England for Yorkshire Humber. Paul, we'll very much look forward to hearing what you are predicting for us and what we're in for, particularly in the next, I'm saying the next few months, but I think it's daily rather than months, isn't it?
Thank you, Lisa, and thanks for loading the slides up, Lucy. So hello, everyone. I'll tell you first of all a little bit about the Yorkshire Humber Agency of the banks. If you move us on to the first slide, Lucy, thank you. So the bank has agencies in all the English regions, Northern Ireland, Wales and Scotland, and it has done for many years. So we are essentially a very London-centric organisation, but we have had regional agencies for a long time, and really it's a twofold role. I recognise some of the names on the call, and I know some of you are contacts of the Bank of England, so each agency has a sort of large cohort of contacts that we speak to regularly to try and build up an emerging picture of what's happening in the economy and what firms are actually seeing on the ground and what some of the emerging trends are. And that sort of picture of what's really happening for the UK economy is absolutely vital for our policymakers, both in terms of monetary policy and financial policy and regulation, to get the best sort of policy outcomes that we can possibly get. And the other role is doing things like this. We try and bring the bank's views and work out to businesses and other organisations in the region. So that's very quickly, that's us. Not a great time to be many things, I guess, during COVID, but I'm pretty sure not a great time to be an economic forecaster. Thankfully, it's not one of the jobs that I have to do, but I don't envy some of our teams in Threadneedle Street who are doing this. So clearly, any forecast we're presenting has to be taken, I suppose, with a large pinch of salt, in the sense that a forecast is only as good as the assumptions that go into it. And clearly at the moment, the assumptions that go into our models and our forecasts are subject to a heightened level of uncertainty. And I suppose the key aspect of uncertainty is that really we don't really know what will happen with COVID over the months ahead, and therefore we don't really know how households, businesses and governments will react to it. I mean, we've got some ideas on what's happened so far and what we think will happen further out. So that's the key uncertainty, and the assumption that we have in this forecast is that the direct impact of COVID is assumed to fade away gradually over the forecast horizon, which is out to 2023. And that household spending and eventually investment recover over that timeline. The other major uncertainty we have, of course, is that we don't quite know what the free trade agreement, if it will happen, what it will be. It should say that the bank always assumes that government policy is implemented and would never publicly take a view that it might not be. and we certainly wouldn't include a contradictory assumption in our forecast. So this forecast assumes a deep free trade agreement with the EU from the 1st of January 2021, and of course we'll all have our personal views on how likely that actually is. If you could move me on one, please, Lucy. Thank you. So the key economic variables that we predict are GDP, unemployment and inflation, the consumer price index, so shown in those three charts. These we call the fan charts, and essentially the sort of thick, brighter section in the middle is our sort of central projection. And the lighter shaded regions are a sort of zone of uncertainty, essentially. So, the potential outcomes. And what I should say is that these fan charts are much wider they would usually be, and that reflects really this sort of heightened period of uncertainty that we're going to. But just to say very quickly, what we're predicting for those three key variables. So GDP. I think we've seen, and we talked about the V-shaped recovery. We've very much seen a V-shaped recovery. I think July's GDP was within 10% of the pre-COVID level, and well up from the April low point. What we're predicting going forward, though, is that sort of rate of improvement from that low point in April, that slows down. We don't actually see GDP getting back to the pre-COVID level until the end of 2021. And it's starting to get close by the end of this year. We think Q4 GDP this year will be about 5% below the pre-COVID level. And then it's a more gradual sort of improvement throughout 2021. Unemployment is very much the reverse. We see unemployment going up to sort of 2.5 million people from around 1.5 million now. So that's from about 4% of the working population up to 7.5%. So a significant increase, and coming down perhaps a bit more slowly than GDP is increasing. And I'll come back to why we think that might be, why the labour market might take a bit of time to adjust. And probably no surprises to people that inflation, we think, will stay very subdued, returning to the 2% target probably in about 2022. If you could move me on one, Lucy, thank you. So I'll say a little bit about some of the detail. So the chart on the left is some Bank of England data on actual spending, using some of our payment system data. One of the interesting things about, I suppose, during this period is that the banks had to get a lot smarter at sort of looking at what we call faster indicators. So trying to get a sense of how things are changing month by month or week by week. Not a big surprise, I think, in that chart, that top red line, so sort of staples spending, so food and so on, that stayed very near to or above pre-COVID levels. Delayable spending, that second line, has recovered a lot more quickly than we'd expected, I think, and we'll have all seen the reports about people sort of rushing out to improve their homes so they can have some office space or their gardens and so on. So, and we very much see that effect, I think, in a lot of the businesses we're speaking to. And then perhaps no surprise that work-related and social consumption are starting to increase since that sort of April low point, but at a slower rate, and also reflecting that some businesses in those sectors are actually still closed under government guidance. The right-hand chart shows various survey measures of investment intentions, and I don't think it'll come as any surprise to see that most firms, not all, but most firms, are very much parking investment for now, just doing essential maintenance and repair investment, really trying to maintain cash flow, and also a sort of sense of not quite knowing for some firms what the post-COVID world will look like, and actually where do they really need to invest going forward. You could take me on one. Great. So again, thinking about consumer spending, talked about sort of social spending recovering fairly slowly on the left-hand side. This is a decision maker panel survey showing confidence around going to the cinema or going to indoor restaurants, and broadly shows that about 50% of respondents wouldn't feel terribly comfortable going to an indoor restaurant or a cinema. So whilst certainly in Sheffield where I live, indoor restaurants seem to be very busy, for a lot of people they're not returning, and that's holding back to some extent the recovery in social consumption. The right-hand chart I think is quite interesting, and again, perhaps not surprising. Lower income households, it shows that actually their savings have declined during COVID. They've had to eat into savings or indeed take on more debt, whereas higher income households have tended to have unplanned savings. And I suppose a big question for us is about the speed of recovery, is to what extent and how quickly do some of those lower income households try to pay down debt or build up their savings again, and do higher income households sort of go out and decide they'll spend some money on a car if they can't have a holiday or whatever it is, actually, or do they keep that money as something of a buffer to protect against sort of risks of unemployment or other emergencies, essentially. If you could take us on another one. So I'll say a little bit about the labour market. I suppose no surprise that employment intentions of firms on various survey measures are well down. That's the left-hand chart, and we're expecting some of the job losses, a lot of the job losses, to come in those sort of higher consumer-facing services sectors. So things like retail, hospitality. You've all seen the news headlines about job cuts in some of those sectors, sort of national, in big national firms. And I suppose one of the things, I talked about why unemployment perhaps comes back more slowly than the recovery in GDP, and that's partly because we think that a lot of the people who are made unemployed will be younger, lower skilled people, and to actually sort of retrain and get the qualifications they'll need for some of the jobs that will come into play from 2021, they will actually need an element of retraining. So there'll be some sort of mismatch, labour market mismatch may be greater than usual, and it'll take time to get people back into employment. You could move me on another one. Again, sort of on the labour market, I think the left-hand chart showing that firms, the majority of firms are expecting uncertainty around coronavirus to go well into 2021 and 2022, and very much we'd expect that to weigh on employment intentions. The bottom right-hand chart is showing how sort of unemployment to employment flows have worked over the last sort of 15 years or so. And I suppose the thing to note is that after the global financial crisis, 2008, 9, 10, it took time for people who were in that stock of unemployed to actually sort of move out of that and into employment. And again, I think because of this mismatch issue with people, with younger people needing to build up qualifications and retrain, we think that's likely to be more heightened than usual. So it'll take time for unemployment to come down. So just this last one, I'm really just reiterating, sort of seen a steep improvement in GDP, but that's going to start to become more gradual fairly soon. We expect central projection is getting back to pre-COVID levels end 2021. Unemployment peaking at 7.5% and gradually declining back to the pre-COVID level of about 4% by the end of the period, the end of the forecast period, which is 2023. And generally inflationary pressures remaining pretty weak, getting back to the 2% target around 2022. Next slide. So I just wanted to include, because we were talking particularly about sort of international trade and exports, I just wanted to include some of the detailed data. So you'll get these slides after the event, we can send them out. But really just to say that for the UK as a whole, for 2020 as a whole, we think UK GDP will be about 9.5% lower than it was in 2019. Now that compares to about just over 6% lower for world GDP, where world GDP is weighted on UK export shares. So the UK economy having a fairly severe hit from COVID, more severe than other countries, partly I think reflecting the actual makeup of the economy. We've got quite a sort of a high proportion of spending on things like hospitality, and partly because of the very high death rate that we had in the UK, in the sense that the sort of fear factor from COVID and being out and spending money or being at work has been perhaps more pronounced than in many other countries. If you could move us on one. Thank you. So really just looking at interest rates globally. So we've got the sort of Euro area, UK and US interest rate expectations here. Again, you can look at this at your leisure when you get the slides, but the main message is that globally interest rates are expected to stay, very close to zero, or in some cases even below zero. So we're in for a sort of lower and longer period, it would seem. And just one more, fiscal support. I mean, we've all seen in the UK that the huge support the government has given through things like the coronavirus job retention scheme, and that's been really replicated across the globe. And again, the expectation is I think within the markets is that fiscal policy will stay very loose for some time to come. So there isn't a sort of sense that governments will sort of return to austerity anytime soon. There's more of a sense that with interest rates low, most governments will take the view that the debt can be a problem for those who perhaps come later than we might. So a long-term issue to be resolved. I think that's my last slide. Oh no, one more. A quick word on bank policy and the Monetary Policy Committee's perspective. So policies remained unchanged now for two of the meetings. So interest rate remains at 0.1%. The bank's continuing its quantitative easing, its asset purchase program. In March and April, that program was conducted at a speed far greater than the bank's ever done in its history to try and build liquidity in financial markets, and that's now returned to a sort of more normal level. The Bank of England is continuing its support for commercial banks to access funding as cheaply as possible, particularly where they can show that they're lending to SMEs. So there's special incentives where they're lending to small and medium enterprises. And something the committee doesn't do very often, but does occasionally, is they give a little bit of forward guidance. And they gave some forward guidance in the August report. And that's the final bullet there, which you can read. But essentially, it's saying that the Bank of England won't do anything really stupid. So essentially, if we can see that the economy hasn't recovered fully, we're not going to do anything like raise interest rates or sort of tighten policy. The bank's basically saying that we need to see a really strong, sustained improvement in growth and inflationary pressure building before there was any consideration given to tightening monetary policy and raising interest rates. So that is it for me. I'm very happy if people want to contact me. You can see my email there. There is one more slide, which is really just for information, but it just contains lots of the detail of the forecast, which may be useful for people to see, but not one to go into detail on now. So that's it for me. I'll hand back to you, Lisa.
I think we need to go to Specsavers to have seen those tiny little numbers. Thank you ever so much, Paul. Our audience is very quiet today. We have no questions and no chat. I would have been quite interested to see what your fan looked like if you assumed that government policy won't happen, but that's probably one for another day. So, and I'm going to pick up with Chris later and challenge you on one of the slides that was interesting there was around business investment and people holding off. So just to prep you, it'd be quite good to hear your views around, particularly around capital allowances that are due to potentially change in December. So I'll tee you up for that one. We're going to do another poll. So thank you, Paul. If everybody wants to have a think about whether there's any questions burning questions for Paul that we can pick up at the end. It looks like he's just trotting off for something.
I've got someone at the door. I'll be back in 1 minute.
Oh, okay. That's a common thing recently, a delivery. Peter's just had to put his dog away so the dog didn't cause havoc. So we're going to, Lucy's just going to bring up another poll. So Lucy, if you can bring up poll number 3. So if you could pick your top 3. So what do you consider to be the biggest challenges to trading internationally? So if you could pick what your top 3 are, and again, this will help us drive future content and future speakers. Okay, so top 1, tariffs and trade barriers, and then neck and neck, tax, VAT and duties, and red tape and regulation. So slightly different to the survey that we did back in May. Peter, over to you. So Peter, given those results, how can the International Trade Forum help us in this COVID period to combat some of those challenges?
Thanks, Lisa. Yes, interesting set of results, and I'll come to those as I go through my presentation, if that's okay. But just looking at the results that you previously had from the Creston survey, and then the first two polls of this session, it's encouraging, obviously, to see that international trade is an important aspect for many UK businesses. And my feeling now is it is a crucial time as big businesses continue to work through COVID-19 and effectively prepare for the end of transition at the end of this year. I think it's fair to say that Brexit, to some extent, has taken second place for the earlier part of this year, as companies have tried to manage the COVID crisis. But I think it's also fair to say in the last month or so, there's been a definite uptick in preparing for Brexit, and that's from businesses and government alike. And the government has got an extensive to-do list that it's working through presently. And if I'll just briefly go through some of those things, obviously not going to spend too much time on them, but as tariffs and trade barriers were quite high up on your poll just then, it's obviously important that we see that the government is looking at free trade agreements and trying to get some of those over the line. So earlier this month, it was recently agreed in principle, the free trade agreement with Japan. And that was making the number of previous EU agreements signed or agreed in principle, that brings it up to 21, covering 49 countries. And there remains a further 13 existing EU agreements that the government are currently still working on and trying to get those over the line as soon as possible. Those agreements amount to around about 16% of UK trade. So it's a significant amount. Obviously, the other area that the government are working on is the US, which is our largest individual export market, and the free trade agreement negotiations are in progress, and they've agreed to continue at a pace through autumn. Obviously, we don't need to be, we're all well aware that there's a presidential elections coming on later on in the year, and we might have to contend with that. And obviously, we've no idea what impact those might have on future discussions. We'll just have to wait and see. The majority of UK trade, as we know, is our main trading partner, collectively the EU. It's about 50% of UK trade, and today sees the start of the final round of formal talks between the UK and Europe, with a stated deadline of the 15th of October if a deal is going to be reached. So we are very, very much at the sharp end of all the Europe FTA, and whether we'll get something over the line, well, we should know in a matter of weeks. But like with a number of deadlines, they sometimes come and go, and we don't see the end result until further down the line. There are some big political issues that need to be resolved on the EU free trade agreement, not least the Northern Irish Protocol that's contained within the withdrawal agreement. And at the moment, we've got the internal market bill passing through Parliament, and it's not clear quite yet how that's going to be resolved. Maybe later on this week, we'll have some indication of how that is going to be resolved. So not surprisingly, there remains a high degree of political uncertainty surrounding all these trade talks, and this makes it very difficult for businesses to prepare for the end of transition. And certainly there's not much time. There's less than 100 days now until transition finishes. The government issued last week the reasonable worst case scenario. And now that the hauliers are having to currently digest this, as procedures are being considered to limit disruption at UK ports. And obviously this includes the well publicised implementation of the Kent access permit. So Hawley is trying to understand that and what they need to do in order to cross the borders come January 21. So I imagine preparing for Brexit is now high on everyone's agenda, and I'm sure they're ensuring that they have got the correct administrative procedures in place to cover such things as export declarations, VAT considerations, the use of the most appropriate Incoterms, and what duties would be payable through WTO terms if it's a no deal. And indeed, as you've already mentioned, Andy's going to cover that in the next presentation. So I have to admit, I'm quite happy to leave that to him. And I don't want to steal his thunder any further on that particular point. So international trade is obviously increasingly important to businesses. And if handled correctly, can be very rewarding to businesses financially, but also can be a very enjoyable experience as well. And this is the area that the ITF specialises in, is the fundamentals to exporting and trying to help remove those barriers that are perceived by businesses. And the ones that you mentioned particularly are inexperience, language and culture, access to finance, currency fluctuations. All those we can either help with, or we can signpost people to service providers that can offer assistance. So the fundamentals to exporting, it requires a serious level of commitment, and it has to be considered as a long-term investment at senior management level. An exporting strategy needs to be thought through carefully and then be given the time to develop. It takes a while to build up these overseas relationships. And as I say, this is an area that the ITF can assist. We're a member organisation made up of businesses who already export extensively, or businesses who wish to develop their export strategies, and a select list of service industries who can assist in supporting the export effort, and not least our sponsors, BHP and Irwin Mitchell. To this end, the collective experience of the ITF membership is second to none, and therefore provides an excellent and comprehensive support network that businesses can tap into. Whichever market you're looking to target, extensive market research is imperative, and this can include desktop research, sharing contacts and experiences with other exporters, and using the various matchmaking services that are available. We've got good relationships with the 3 chambers of commerce in the region, Sheffield, Barnsley and Rotherham and Doncaster. We also have good relationships with the Enterprise Europe network, all of whom have excellent overseas services that are available. Traditionally, the ITF has organised various trade visits to exhibitions as we consider this an excellent entry point into specific markets, and enabling businesses to take a look before committing significant resource. And it's so important to get the right local partner, and this applies to whatever level you're entering the marketplace. It's also so important to build a relationship based on trust, and therefore it goes without saying that the more you can do up front, the better chances of getting it right. Obviously, the other elephant in the room is COVID-19, and that has inevitably restricted export development plans as business initially had to deal with lockdown and now have to manage the ongoing impact of social distancing, self-isolations, and more specifically to exporting, travel restrictions and quarantines, making it very difficult to plan any physical travel. But again, it was encouraging to see from your poll at the beginning that overseas trade has not been cancelled by the majority of the people that are on this call today. So that's excellent to see. And anecdotally, our members, who cover a fairly broad section of industry sectors, all found initially COVID-19 to be a massive challenge, but now are looking at ways of developing and increasing their business. And some are now faring better than others, and typically international trade is playing an important part of their recovery. Recently, we've heard evidence of businesses taking advantage of market share and considering acquisition routes. We've heard of businesses, early adopters of new technology to assist their sales efforts, taking advantage of disruptions to existing supply chains, and adapting their business models either proactively. There's been a lot of talk of getting into the PPE supply chain, or being in the right place at the right time and reacting accordingly. So many businesses have used many tools in order to continue and increase their trade, and particularly internationally. I think if you ask any of those businesses, face-to-face meetings and the subsequent informal discussions and socialising after the working day is completed cannot be equalled. That opportunity to see people, meet with them, sit down with them and talk about everything in addition to work is so important. When it comes to building up relationships overseas, but as ever, you have to deal with the current environment and react accordingly. And therefore, obviously, more meetings, exhibitions and trade visits are being held online. And we at the ITF are adapting our models and activities to reflect this. This is not ideal, but it doesn't move away from the fundamentals of exporting that still remain. And that's people want to do business with people. People want to trade. And many businesses are happy to form part of that support network in order to help other businesses achieve their international trade goals. It's also changed mindsets as well, and more people are accepting of the online meetings, and this approach has undoubtedly made the world a smaller place. An example of that, we recently ran an online trade visit to Ireland in conjunction with the British Irish Chamber of Commerce. And it was evident that there was a desire to extend networks and contacts on both sides of the Irish Sea. We're also currently working with the British Irish Chamber of Commerce to promote a new online platform called Commend. And this provides businesses the opportunity to recommend and collaborate with each other and build up the relationships which we obviously see as so important in ongoing business relationships. Selling online is not surprisingly proving to be a popular outlet for our members, and COVID-19 restrictions have definitely seen businesses accelerate this method of selling. This provides a more open market approach, but there are still issues that businesses must consider. You're still selling across borders. You still have to look at local regimes such as sales taxes. You might have to consider local stocking policies. You've always got to consider your product compliance. And there may be an after-sales service requirement that has to be considered. And even still, culture and language are some of the things that have to be considered even on online selling. And our members have some of them have attended some very good courses that have been available through the DIT to assist in developing this type of strategy. So my final point is on access to finance, which is one of the other questions. And I only mention this is because the DIT will soon be launching their internationalisation fund, and match funding of between £1,000 and £9,000 will be available to eligible SME businesses. And this money can be used for, but not limited to, market research, IP advice, translation services, international social media, trade fairs where no of the TAP funding, Trade Show Access Programme funding, is available, independent market visits, and consultancy and other international commercial services. So it looks to be a quite broad range of things that can be covered by that funding. As I say, it's going to be launched very soon. So if people are interested in that, please, or any of the things I've mentioned this afternoon, please do get in touch and we will point you in the right direction. Thank you very much.
Thank you, Peter. We've got a question that's come through. I'm going to save it to the end, if that's okay, Alison. Thank you for raising that. We have another poll just before Andy does his little bit. So, Lucy, if you can raise the final poll, Would you say your business is ready as much as it can be, is the proviso, which I think comes back, Alison, to your question. How can we prepare for something which we do not know what the rules will be? Very good point. If you could answer this question, that'd be great. Okay. Yeah, I think yes, somewhat is very encouraging, but again, I think this also concurs with Michael Grove of 50% of businesses are not prepared. So we've got 39% that are on the more negative slant. So Andy, it's not too late. I think you're going to trot us through how people can be doing, what people can be doing.
Afternoon all. So I'll just try and share my screen. So hopefully everyone can see that. Just trying to. Why is it not working? There we go. So yeah, thanks Lisa, and afternoon also. Lisa just asked me to touch on a few points that we're seeing, I suppose, from a Brexit point of view, conversations we're having with clients, given, as Peter said, we're not far away now from the end of the transitional period. So most of you will know, formally left the EU on the 1st of January this year. We entered into this transitional period up until the end of December this year, where effectively all the rules stay the same in terms of that trading relationship with the EU. But from the 1st of January next year, in the absence of a trade deal, we've very much left the EU on a sort of a no-deal basis, when the rules can be sort of very different. So purpose of this really, just in the short time we've got, is just to give an overview of where we're at and some of the things that we can start thinking about, even though I appreciate, I think the question sort of touches on this as well, is that there are quite a lot of unknowns yet, and we don't know some of the detail, and that's making it very difficult for businesses to prepare, and certainly a lot of that uncertainty doesn't help. In terms of the free trade discussions, as Peter said, Michael Gove's in Brussels this week, we understand, trying to negotiate that, and they've got this backstop date of the 14th, 15th of October, in terms of when they're hoping that the trade deals need to conclude by. Sort of going beyond that date, it starts to push the boundaries of the timescales that remain. Now, I suppose two key questions for me, given everything that's happened this year from a sort of COVID, financial uncertainty and economic perspective, and I suppose a personal opinion in some respects is, will the transitional period be extended beyond the 31st of December? The UK government's perspective at the moment, and certainly the position that they will adopt and they will stress, is that won't be extended, and that's very much their commitment. However, can the UK really walk away from a deal in the current COVID climate? My own personal thought is no, given the stress and pressure that will place on businesses. So I wouldn't rule out an extension to the transitional period. But as we've seen, I suppose the difference perhaps with some of the delays we've seen previously towards the back end of last year with different majorities and in the Commons, and how that might impact on the government strategy, we're perhaps at a little different time now. So I suppose the question there is, and nothing can be ruled out, but it's again, the uncertainty doesn't help, but I certainly wouldn't rule out an extension, albeit the government's sort of saying that won't happen. And I suppose what can we do? I suppose the main impact of obviously, I'm sure most of you will be aware, the impact of the absence of a trade deal is that automatically then we're talking about tariffs and customs duties on trade with the EU, so the remaining 27 member states. So automatically there's an additional cost and pressure on UK businesses in existing trading relationships that you have. And I suppose from our clients' perspective, we have clients that have international, rest of the world trade relationships that will help to be able to manage that. But we also have clients that only deal with the EU at the moment. So them dealing with the EU from the 1st of January brings a different set of issues and problems that they'll have to deal with going forward. So, again, very uncertain times, and again, not helped with everything that's happened this year with COVID. So just looking at I suppose the question is, planning for Brexit, it's not too late. So there's a raft of information out there, both from an HMRC perspective and things you can get access to, advisors putting out lots of information, and also lots of the trade forums as well, in terms of what businesses should be concentrating on. So I suppose what this tries to do is, in this uncertain climate, top 5 considerations in terms of Brexit. We're still not sure exactly what's going to happen, but what can you do now to do some proactive thinking about Brexit? This is by no means a definitive list, but would be some of my sort of key recommendations for things to be thinking about in the short to medium term. So first one, EORI numbers. So this is the economic operator registration and ID numbers. That's essentially necessary for all trading relationships and movement of goods between the UK and EU. So that's going to be fundamental that businesses need to have that in place. Duty deferment accounts. Some of you may already have these at the moment, but essentially a duty deferment account arrangement in place with HMRC allows you to, instead of having to pay for individual consignments to release those goods into free circulation, you can effectively move on to a direct debit type arrangement and spread the duty payments over a longer period of time. So essentially a cash flow benefit, as opposed to having the pressure on individual consignments that are released. So we're certainly talking to a lot of clients at the moment about how that could work. The slight downside of that is the banking guarantees that you may have to provide. And we have seen, Lisa and Chris, correct me if I'm wrong on this, but certainly some clients that have been looking at CBILS applications where they're looking at duty deferment, it's had some impacts on that. So there's sort of a wider commercial impact there as well to think about. Sort of thirdly, looking at agents and getting agents in place if you don't already have those. Obviously, agent, in terms of those organisations that can help you with managing international trade, they've got the expertise and understand how to manage a lot of the rules and requirements and documentation issues that are going to come up. So that's obviously going to be quite important going forward. A key question that we get asked a lot is probably around who's responsible for the importation of goods, and in terms of whether that's the seller's responsibility or the buyer's responsibility. That can have quite an important difference in terms of the liability for duty, where that sits, and ultimately how you then manage jurisdictions and your supply chain within the EU. So again, I suppose before you get to the detail of understanding what the technical aspects of that are, it's just having an awareness of how that should be managed in your supply chain, what the contractual terms say, and ultimately just having an understanding of where the current responsibilities for that sit. And then finally, the sort of other key one, just in terms of around customs clearance procedures. So what a free trade deal will do is it will probably remove a significant amount of the duty burden. What it probably won't do is it won't remove customs checks. So even if we're in a free trade arrangement with the EU going forwards, there's likely to be some customs checks that we don't have at the moment. So again, there's probably additional costs and procedures that need to be thought about around that as well. Just on that, in terms of help and support available, you may or may not be aware, HMRC have announced some grants, some financial support in terms of dealing with systems and procedures, in terms of managing the cost impacts of that going forward. So again, given the timescales between now and the end of the year, that might be something to look at as well. And then I suppose just moving on to just some further general considerations in terms of trading with the rest of the EU going forward from a UK perspective. Fiscal representation and what elements of changes may be needed with that going forwards, and again linked to whether you need local VAT registration requirements in other EU member states. We've seen historically that some EU member states can be quite difficult in terms of dealing with businesses that aren't established in their jurisdiction. So I suppose a key consideration for Chris and I from a tax point of view is to understand how that will change going forward when the UK is not part of the EU. So for example, will jurisdictions make it difficult for UK businesses to set up what it needs to do in certain EU countries? They could do, I suppose that the devil's going to be in the detail with that one, and something we'll need to look at quite closely as we move forward. And again, probably linked into sort of being quite proactive in terms of that supply chain management and how you can manage and mitigate some of those issues. So again, we've got clients looking at whether they need to set up in Ireland, for instance, as a way of managing the supply chain into the EU. And I suppose two key considerations that have perhaps been lost in some of the detail that will come into play, I suppose, regardless of what happens from the 1st of January going forward, is the terminology around postponed VAT accounting. So at the moment, where you import goods into the UK from outside the EU, you have to pay the import VAT and duty on importation into the UK before those goods are released. The actual import VAT accounting is going to be on a postponed accounting basis from the 1st of January, so you can actually account for it on your VAT return, as opposed to having to pay that import VAT on release of the goods, which is quite a big cash flow benefit, and will work similar to some of the rules we have in place with the EU at the moment. And there's also going to be a soft landing period for import declarations and duty up until the 30th of June next year. It's not going to be mandatory, but again, it's hoped that provides some leeway and help with businesses getting up to speed with sort of the changing requirements from the 1st of January. And I suppose just to summarise a lot of that, whilst there's a commitment from the government and HMRC to try and simplify and streamline this process as much as possible, there is a lot of detail that needs to be considered. And I suppose regardless of a free trade agreement, although that will help, there are going to be costs and requirements and new processes that need to be considered from day one for us trading outside of the EU. So that's going to be really important, I suppose, to pick that up as we go forward. So I appreciate that's a really quick overview in the time we've got allowed, just with some of the key considerations. But my email address is on there, and obviously we're all keen to answer any questions as a follow-up to this. Just as part of this work as well, you may have seen that BHP, we've issued an importer and exporter checklist last week with sort of 10 to 12 questions on each in terms of importers and exporters, with some of the considerations and some of the key areas we see as being relevant at the moment. And again, just to try and assess where everyone's at as well. So we're going to circulate those checklists with these slides as well as a follow-up to this. So that's pretty much it, I think, Lisa.
Thank you, Andy. There's a couple of questions that have come through. So one of them specific on a specific VAT issue. So we'll probably take that one offline, Andy, if we can.
Yeah, okay.
Chris, whistle stop tour in 2 minutes because everybody wants to go for their tea.
So I will now share my slides. Lisa has just told me the meter is running and I'm on the clock, so I will.
You always are.
Off.
I do apologise. Yeah. We should have put you first this time. He always gets the last slot, doesn't he, poor Chris?
It's not a problem. I'm going to set the scene by saying that, to be honest, I love budgets. And whether it's the thrill of the budget speech, the adrenaline of the press releases, or all the things around it, budgets are a good thing for tax advisors. And so the expectation, as Lisa alluded to at the start, was that we're going to use this workshop to set the scene and get the momentum toward an autumn budget. So imagine the disappointment when last week it was cancelled and all of a sudden we had to think about what the framework is and what we're going to talk about today. But reflecting on it, and despite the disappointment, I think the decision by the Chancellor to cancel the autumn budget is the right one. And I think if we go back to Paul's presentation, and what that told us was uncertainty. It told us that the risks by the economists were being skewed to the downside. It told us that the fan charts were getting wider. And I think on that basis, it's the right thing to move the budget on to a later date and to concentrate on those things which are really at the forefront of people's minds. And that's confirmed by the fact that Paul expressed it in a different way, but the Bank of England has confirmed that it's going to act sensibly and not be stupid. And really, in cancelling the budget, I think the Chancellor is saying the same. There are too many things that are on the too difficult to deal with shelf at the moment that they need to crack on with before they can get to really setting the scene for a budget and the tax framework of the UK PLC. It's clear that the direction of travel is, however, towards tax increases. Now, whether that's now or in March, it's on its way. And there's a bit of analysis that sort of looks at what taxes generate the most immediate impact on the exchequer. And actually it's VAT. And we can see from a number of the measures that are around at the moment that the government have looked to really promote and incentivize certain parts of the economy by reducing the VAT rate. And I can envisage that it will do the same conversely by increasing the VAT rate in certain areas and have an immediate impact on the exchequer. Similarly, we have a housing market that seems pretty robust at the moment in certain parts of the country. And it might be that having sort of tried to encourage it by stamp duty reductions for first-time buyers, that the headline rates of stamp duty for mere mortals actually increases, because that would flow to the exchequer. And then finally, corporation tax at the moment is on 19%. The direction of travel was actually down towards 17%, but that was cancelled a few months ago. And there is a school of thought that says actually that we ought to move back to that two-tier level of corporation tax where larger companies pay at a higher rate. And I'm old enough and been around long enough to know and remember rates of 30, 35% in corporation tax. So that might be where we end up in terms of immediate tax changes. What I will say in relation to tax, and again, this again goes to the idea that there's lots of too difficult things to deal with on the shelf, is that there are lots of structural tax changes around at the moment that were alluded to in the March budget. We anticipated that they would appear in the autumn budget, but simply and clearly will get now pushed onto a March budget. And with no order of preference, capital gains tax is quite clearly on that agenda. The Chancellor has written to the Office of Tax Simplification and said, look at it, and look at it specifically into relation to why it's less than income tax and whether that should be addressed. Inheritance tax actually was presented to an all-party parliamentary group in January of this year with a view to correcting that. So that might well change. And then there's the overriding presence of tax relief on pension contributions, which at the moment is at higher rates, but could be restricted to basic rate relief. So if that's the direction of travel, and that's the things that are on the books at the moment, quite clearly now is an appropriate time to review your tax position, despite the uncertainty over COVID, despite the uncertainty over Brexit, because now is the window probably of 5-6 months where you can really deal with things as they are now before things change. Let's move on to the next slide. So what did we end up in instead of an autumn budget? Well, it was termed the Winter Economy Plan, and it's a number of specific measures that are introduced to support businesses over what the Chancellor views are going to be a very, very difficult winter months. Demand is going to fall off. It's going to be cold, wet and dark. We will be coming out the other side of the CJRS scheme. And so the whole emphasis is to project jobs through the resurgence of the virus and the difficult winter months. And central to this plan is the new job support scheme, which I'll tell you about in a moment, and also an extension of the self-employment income support scheme. And then on the back of that, there will be additional flexibility in paying back loans or deferred liabilities that would normally come back into charge in January, February of next year. So let's talk through those in a little more detail. The coronavirus job retention scheme does finally end on the 31st of October 2020. And whether it's version 1 or version 2.0, it has delivered what it said on the tin. All credit to the Revenue. They wrote a protocol and a software within 2 to 3 weeks and delivered it. It was easy to access. It was a scheme where actually if you submitted a grant claim, you received your money back automatically within 4, 5 or 6 working days. And it has saved and secured many, many jobs in the UK. And there's 9 million people who have been funded by the CJRS scheme. The problem with its success is that it is a major hurdle that we need to get over. And whilst the amount of reliefs has reduced over in August, September and October, there is still a view at business level and government level that once the scheme ends, all that will happen is that there will be wholesale redundancies or job losses. And that's really where the job support scheme comes in, because it starts on the 1st of November 2020. It requires an employee to work for 1/3 of their normal hours and to be paid for that 1/3 of their normal hours. And so the idea is that rather than having one person working 100%, you will reduce the hours of 3 people and keep them all on and pay them 1/3 of their normal hours. For the 2/3 not worked, the government and the employer will both pay 1/3 of their usual hours, resulting in a grant that will be capped at £697.92 per month. Now, I'm not overly bright at times, and so I looked at it and I thought, well, 1/3 of normal hours, 1/3 from the government, and then a final third from the employer. Well, if you add up 3/3, they're getting paid full amount, but that's not actually how it works. So the first third, you get paid your normal wage. For the next 2/3 of your salary, you get paid 1/3 of that by the employer, so 22%, and you get paid 1/3 of that by the government, so 22%. So in total, an employee will get paid 77% of their normal wage for working 1/3 of their normal hours, and of that, 55% will be funded by the employer. So there will quite clearly be a cost to the employer. And the idea with this is that it will wean us off the CJRS scheme and get us onto the job retention scheme, job support scheme, and get us to the point where we are actually engaging people, using them, but at restricted levels and paying them a decent wage. The job support scheme is available to all SMEs, whether they've used the furlough grant scheme or not, and to large businesses where they can show that they have been affected by COVID-19. So it's open to more, and I think it's a really great sort of lateral way of thinking about how we get over the hurdle of the loss of the CJRS scheme. It is designed to sit alongside the job retention bonus. So if you have employed somebody still in January 2020 who was on furlough under the CJRS scheme, then the employer will receive a £1,000 bonus. And in the government mind, that is viewed alongside the support it provides with the job support scheme. And that will mitigate the cost to employers of keeping people on board. The CJRS scheme was complicated. I speak from personal experience of doing grant claims. The job support scheme itself is not overly simple, and they result in complex calculations. So for me, another way of increasing the tax take for the Exchequer will be the HMRC activity in checking claims that have been submitted. There has already been a huge uptake in whistleblowing, which has resulted in a number of arrests and prosecutions. And in relation to those claims that have been correctly made, they will still be checked in detail and audited by the revenue. So if there's one further message to take away from today, it's check your furlough claims, check your job support claims, and if you're not happy, then get somebody like BHP to do it on your behalf. So what else is there? Well, there's an extension of the self-employed support. It's not quite as generous as the original 2 grants, and it's a bit more restrictive. The grant is effectively in 2 parts. The first grant is a lump sum payment equivalent to up to £1,875 per month to cover the period from November to January 2021. In order to claim it, you've got to be actively trading. So it doesn't support somebody who isn't doing anything as a result of COVID. You've got to be actively trading, and you've got to have demand that has been reduced as a result of COVID-19. And you've got to be able to prove both. There will be a second grant. We don't know what that is yet, and it's intended that that will cover the period from February 2021 to the end of the tax year, with the premise being that employed people have been covered by CJRS and the job support scheme. Self-employed have been covered by the SEIS scheme, and that really the only people at the moment that aren't covered are directors and owners of their own businesses who have taken their remuneration by way of dividend. And I think the general premise from the government is they're not intending to do anything to change that. We talked about that and the impact on the Exchequer. There is a temporary VAT cut for tourism and hospitality from 20% to 5%. That's going to be extended to the 31st of March 2021, so that's good. And then there's a couple of things that they called new payment schemes. And where you have deferred your VAT liabilities for the period from March to June 2020, then that would normally come back into charge in March 2021. The change in the rules under the winter economy plan is that you can now choose to pay it in 11 monthly installments rather than one lump sum. So you're pushing it on a bit. And then the other thing that's just come out is that where you have self-assessment liabilities, your income tax liabilities, then they were bunching up to be paid on the 31st of January 2021. And what they're saying now is that you can have a time to pay arrangement without challenge to defer that liability until the January 2022 deadline. So that's quite helpful. Just pulling together my last slide. I suppose this is about government support, either at a relatively low level or quite high level, where businesses have taken funding from the government either under the bounce back loans or under the CBILS scheme. And the government is saying that you're going to have absolute flexibility as to how you pay that back. So in relation to bounce back loans, they're loans of up to £50,000. The repayment term is going to be extended to 10 years. So that's good. It's pretty cheap interest anyway. You can have an interest only period for 6 months. And you can do that 3 times during the payment profile. So you've got 3 chances to sort of defer the interest. You can have a payment holiday, and that payment holiday can be up to 6 months, but you can only do it once. And then finally, in relation to CBILS, lenders providing CBILS can extend the length of the loans up to 10 years. So that's good. And the ability to apply for a CBIL has been extended until the end of November. And I think if I were to be the countdown clock, that would now be the end.
Thank you,
Over
Chris.
to you, Lisa.
I'm mindful that we've overrun, but we've still got the majority of the attendees haven't dropped off, and we've got a couple of questions if everybody's okay for the questions. So Chris, one for you. Don't you think we may need a global tax system soon, looking at the situation with COVID, USA China trade battle, not fair tax havens, etc., or growing monopolies such as Amazon, Facebook, Microsoft? Yeah.
I mean, the great question. I mean, whether anybody's got an appetite to negotiate or work out how a global tax system would work, I don't know. I certainly agree that the transfer pricing legislation that's in place needs to bite and to be used more aggressively. That would counter the Starbucks and the Amazon situations. Tax havens are definitely on the government agenda to be countered. So I agree wholly with that as well. But as to whether anybody's got an appetite, not sure.
Thank you, Chris.
Sorry, other thing I think about on that is one of the things on the government's agenda is actually to try and make UK PLC a bit of a tax haven, not in the tax haven Cayman Islands style of things, but just to make it an attractive place to do business. In that you can set up your entity in the UK, you can pay UK corporation tax, which, as I say, could be at 19%, which is one of the lowest in the G7, and that will entice businesses to come into the UK, pay their tax in the UK, but still trade internationally. So I think, you know, there's a certain way about how you describe a tax haven.
Thank you, Chris. Paul, one for you. Can you give us a little more info on your CPI predictions? It's really tough not to assume that we are going to pay back all the COVID-related government support by the high inflation.
Yeah, I suppose the thing we need to remember is that the bank operates under a government mandate, and the government sets a target for CPI of 2%. So, you know, unless there was a specific change to that target, then the bank will always operate to try and hit the 2% target, which is sort of why the forecast tends to sort of converge towards 2% usually, because we assume we're changing policy as best we can to hit that. So that's the reason for that.
And I suppose the final one before I close is I'm concerned that Michael Gove has stated that all UK businesses, and this is probably for everybody, have had time to prepare for Brexit, but how can we prepare for something which we do not know what the rules will be? I'm interested how other EU countries will manage their VAT upon imports, as for high value commodities, this is a huge worry to my industry. Do you foresee European customers moving to other supply, resulting in loss of business to UK exporters? Perhaps Andy first on that one.
Yeah, so I think the last bit of that, definitely a risk in terms of EU businesses looking elsewhere. It is a really difficult one. I don't necessarily agree with Michael Gove. Yes, there's been a lot of time to prepare, but I agree the detail has been changing all the time. So as much as we can take some of the basic steps as we've sort of outlined here, but I appreciate that doesn't get you to the full answer. So again, we just need clarity on that as soon as possible, really, in terms of how it's all going to look.
Peter, are you seeing from your members this concern? This is certainly a concern that clients of mine have been voicing.
Yes, certainly so. Businesses that are dealing predominantly with Europe, I think that is going to be an issue. And how do you prepare? Well, you've got to try and maintain that relationship with your existing customers. We've seen it previously when we've been to deadlines that companies have built up stocks. It's not ideal because it ties up cash flow, and therefore makes it a difficult transition. But that's one way that they've been looking at trying to maintain the supply chain. So it's going to be different, obviously, for every single business, and yeah, unfortunately, we are, well, with regard to Brexit, we are where we are, and you've got to do what you can to get through this. I think just whilst I'm there, Lisa, there was another comment just on the trade agreements moving forward, and some of the opportunities that might come when we are global Britain, which is the whole idea that we have responsibility for our own trade agreements. And yes, there will be opportunities to look further around the world, and obviously the Japanese free trade agreement is possibly the first stepping stone in Britain looking at future trade agreements, particularly with the Trans-Pacific agreement, which has been mentioned in the chat. So I think there's going to be some short-term difficulties for everyone to overcome as the disruption of Brexit comes along. And then we've got to look for future opportunities as global Britain.
So Peter stole my thunder, because that was going to be my wrap up.
I'm sorry, Lisa.
In terms of positivity, I've got William in my ear roll, even though I haven't, because William always ends on a positive, and I also like to end up on a positive. So yeah, we're talking about Brexit here, but the world is a very big place, and William has quite rightly, followed up by Kylie, pointed out that we are still able to trade with lots of other countries on WTO rules. So it is a great opportunity for us. I think we have got some trepid waters in the next few months, not just because of Brexit, because of all the things that have been thrown at us, but we've got some great businesses here in Yorkshire. We deal daily with great businesses, and long may it continue. So I'd just like to say thank you ever so much for all the attendees for hanging on in there. We have gone over, but they've still hung on, so that must be positive. Thank you to Paul for giving your view from a Bank of England perspective. Thank you for Peter for joining us today. Andy for coming on your white horse at the last minute, and good old Chris for hanging on in there to the end of it, and always is interesting. Is interesting whatever he talks about. So. But I'm biased. When we finish the webinar, there will be a feedback form that comes on. It's really important if you can just spare a couple of minutes just to give us some feedback. As I said at the outset, we'd really like to do a series of these, more of these, but only if it's got some interesting content and something that people want to hear about, because we want to add value to you and your businesses. Without further ado, I would like to say thank you, have a good evening, and see you all soon. Thank you.